Welcome. Today we're diving into a really fundamental part of tax law that's getting a new number. Section 109 of the upcoming Income Tax Act, 2025. This is the provision that lets you set off a loss from one income source against a profit from another. Let's get right into it. So here's a situation you've probably run into, whether you're a professional or a business owner. You've got a decent profit coming in from your business, but at the same time you're looking at a loss from a rental property. What do? How do you balance these out to figure out what you actually owe in taxes? Well, that whole process is called inter-head adjustment, and that's exactly what we're going to unpack today. Okay, here's our game plan. First, we'll see how the old 1961 Act connects to the new 2025 Act. Then, we'll get into the nitty-gritty of inter-head adjustments, cover the all-important rules, run through a calculation to see it in action, and then finish up with the key things you need to remember for compliance. As you know, the Income Tax Act of 1961 is on its way out, and the new 2025 Act is set to take its place from April 1st, 2026. Now, with a change this big, the number one question on every professional's mind is, what's actually changing? And maybe more importantly, what's staying the same? Well, here's some really good news right off the bat. The core provisions for setting off losses, which we all know as Sections 70 and 71, haven't been changed. They've just been renumbered. This is huge. It means all the logic and principles you've been working with are still perfectly valid. It's all about continuity, which makes the transition a whole lot smoother for everyone. And this isn't just an interpretation. The official guidance on the transition says it loud and clear. The fundamental structure, adjusting within the same head first, then across different heads, is completely preserved. That kind of confirmation provides a lot of reassurance as we move into the new regime. All right, so we've established that the rules are staying put. Now, let's really get into the nuts and bolts of the mechanism itself. How does this interhead adjustment actually work? Okay, first things first, let's just do a quick recap. Every type of income you can earn falls into one of these 5 categories, or heads. You can think of them as 5 different buckets. This classification is the foundation of the whole system. So Section 109 is the legal tool that lets you take a loss from one of those buckets, let's say house property, and use it to lower the income in another bucket, like salaries. The whole point is to get to a net income figure that gives a truer picture of your financial reality for that year. But, and this is super important, you can't just jump straight to mixing and matching these losses. The law is very clear. There's a 2-step process. First, under Section 108, you have to sort things out within the same income bucket. Only after you've done that can you use Section 109 to take any leftover loss and set it off against income from the other buckets. Okay, the basic idea sounds simple enough, right? Well, this is where you really have to pay attention, because the devil is always in the details. Section 109 has some very specific rules and restrictions you absolutely have to know. Not all losses can be set off against all types of income. Let's look at some key examples. For instance, you absolutely can take a loss from a house property and use it to reduce your salary income. That's a common one. But on the flip side, you cannot set off a business loss against your salary income. That's a major restriction. And it gets even more specific. A loss from a speculation business can only be offset by a profit from another speculation business. And here's a big one. Capital losses, whether short-term or long-term, can never be set off against your salary. Getting these pairings right is critical for accurate compliance. All right, enough with the theory. Let's see how this actually plays out with a real-world example. It's the best way to understand how these rules come together and affect the bottom line. So for our example, let's take the case of Miss Priya. She's got a few different streams of income and some losses for the tax year. So here's her financial picture. She has a solid salary of 12 lakh rupees, a non-speculative business profit of 4 lakh, and a short-term capital gain of 1 lakh. But she's also carrying a loss of 2 lakh rupees from her house property. So how do we apply Section 109 here? First, we pinpoint the loss, which is that 2 lakh from a house property. Then we check the rules. Can a house property loss be set off against salary income? Yes, it can. So we simply subtract that 2 lakh loss from her 12 lakh salary, which brings her net salary income down to 10 lakh rupees. So what's the bottom line? Before this adjustment, if you just added up all her positive income, her gross total income was 17 lakh. By properly applying that 2 lakh loss under Section 109, her final taxable income is reduced to 15 lakh. This one simple step has a direct impact on her final tax bill for the year. Okay, we've covered the law and seen a practical example. So what are the most important points that you need to lock in to make sure you're filing correctly and staying compliant? Let's recap the 5 key takeaways. 1. The rules haven't changed. It's all about continuity. 2. Make sure you update your references. Starting from the tax year 2026-27, it's Section 109. 3. Never forget the restrictions. Double-check them every single time. 4. Always follow the proper order. Intra-head first, then inter-head. And finally, number 5, accurate reporting in your tax return is crucial to get the benefit and correctly carry forward any losses you couldn't set off. And this all brings us to a bigger question, doesn't it? What we've seen with Section 109 is that while the section number has changed, the core logic is exactly the same. So as we look at the new act, which was intended to simplify things, we have to ask, are we seeing real simplification of the tax code, or is it more of a large-scale renumbering exercise? That's a question we'll all be exploring in the years to come. And that's our look at Section 109. If this was helpful for you, please go ahead and like, subscribe, and share it with your network. Your support really helps us create more of these explainers. Thanks for watching. Just before you go, please take a moment to review our disclaimer. Remember, this content is for educational purposes and is not a substitute for professional tax advice.